I wanted to lay out my stock market strategy for 2025. The stock market has been on a solid bull run for over 2 years. Usually, typically, when you look back in history, that's about as long as a bull market will ride for the stock market. I want to lay out the case that the economy is likely to slow down. The Federal Reserve is wrong once again. And because of that, the stock market in 2025 will go lower. Putting those pieces together, looking at what we have for an economic landscape, you can see that there are problems that the Federal Reserve is going to have to deal with. At the same time, this is before Trump. Will Trump do his tariffs? Will we see an extension of the tax cuts that they implemented in 2018? This is inflationary. So let me lay out my stock market strategy for 2025. Let me show you the charts that I'm looking at so you can see that this stock market, this bull run we've seen throughout the past 2 years, more likely than not, is done with. And it could be as soon as this month, January 2025, where we see with employment on January 11th, and then CPI and PPI data on Tuesday, Wednesday, about the 15th, 16th of this month. That's probably when savvy investors are going to step in and start hitting the sell button. Let's jump in and I'll show you my stock market strategy 2025. If you are just joining me for the first time, first and foremost, I am an economist. I apply economic data and how it affects the stock market. The stock market itself is an indicator. It's sort of a reaction to how well the economy is doing. But how do you put economic data together and show what will happen in the stock market? That's such a difficult thing for some people to do, especially individuals who've never looked at economic data. So all I do. Here we're looking at the 4-hour bar chart on the S&P 500. And as you can see, we're a little bit down today after an extended bull run since, I want to say this goes back to May, but I've got another chart here in a second. But you can see that we got information just a couple weeks ago where the stock market sold off heavily. It tried to rebound, the sort of Santa Claus run, if you will. It's time for the savvy investors to come in, take a look around, get busy with the new year. They were on vacation. So this little minor bull market we had over the past couple days, probably done with. Let's move forward and I'll show you some of the charts I'm looking at. Most bull markets run 2 years. Now this is an indicator that when we enter the third year, typically bull runs are done. There's a cause-effect relationship. The bull market happened as an effect, not the cause. The cause, of course, is the economy expanding. Federal Reserve looked like they were likely to continue to move interest rates lower and lower throughout 2025. I sat there all through 2024. In fact, back in 2023, I said the stock market's going to continue to move forward. You can actually find my video on this for Stock Market 2024. But I felt October, November, December of 2024, we would see a sell-off, and I played out the reasons why. First, the economy is too strong for the Federal Reserve to be lowering interest rates. They stepped in September with a 50 cut. They did 2 more cuts of a quarter basis point, so they're down 100 basis points altogether on the overnight. And the expectation was they would continue with that throughout 2025. But guess what? The economy is too strong. The Federal Reserve is starting to pump the brakes on that, saying, yeah, maybe not nearly as much as we thought. I will continuously say they stepped in too early, too fast. Shouldn't have hit the 50. They should have told us we will get there and will likely do a sizable decrease in the interest rates. But they didn't. They went ahead and pulled the trigger. And they're going to pay for that, or we will. The economy itself. This is GDP, gross domestic product. This is the measure, the activity of what's going on within the economy. And as you can see, it's fairly robust. I think we're about 3.1 on an annualized growth rate. This notwithstanding what the Federal Reserve has done with interest rates. They moved interest rates from near zero significantly higher over a short period of time to tap the brakes on inflation growth rates. Now, the whole world was affected by inflation. Two things. Of course, COVID was one of the first breaks. The supply chain broke down. Companies jacked up their prices immediately, saying the supply chain. Then they realized they can get away with it. The supply chain was broken, but it wasn't broken that much. They became profitable. Not enough competition, no one undercut them, so they kept their prices higher. That affected, of course, inflation. The biggest chunk of that was also simultaneously housing. Housing was like 70% of the increase in costs, rents and things like this. Grocery prices, of course, have gone up. Other expenditures have gone up. But the economy as a whole is actually pretty strong. It's growing, notwithstanding, of course, what the Federal Reserve has done. Unemployment rate trickling a little bit higher. Trump had, I want to say 3.48 unemployment rate January 2020. Then immediately everybody said, oh yeah, that bug that's happening in China, I guess it's here. Started laying people off. Biden pulled off a 3.43%, I believe it was, just slightly better than Trump. Neither one of them really do anything for the economy. It's the Federal Reserve. We are getting closer to normalization with the unemployment rate. We used to think that 5% was full employment. This is transitional employment. You're looking for a better job. You're unemployed for whatever reason. Maybe you got fired, maybe you got laid off, maybe you just had enough and are looking for a better job. These individuals are counted within the employment rolls, and this transitional employment at about 4.1 for this month is good. It's solid. Doesn't mean it's paying the bills, but a lot of people are employed. This is one of the most important signals you should be watching for the stock market 2025. The money supply. Money is the fuel that gets this engine rolling. If there's enough money in the money supply and the rate of growth of money is expanding, so will the economy. Plenty of charts to show you on this. So the money supply was jacked up significantly because of the Federal Reserve's actions. They bought up, invented money out of thin air, buying up as much treasury debt as they possibly could to keep the economy moving despite the shutdown because of COVID. Since then, they've been trying to get money, the money supply, back onto a trendline basis. Now, the Federal Reserve, of course, had also tried to be doing a lot of the quantitative easing that they did previously in the 2008 financial crisis. There were 3 rounds of QE 1, 2, and 3. QE 4 was COVID. They almost got to the point where they were getting back to trendline then, and then, of course, COVID hit. This is exactly the same chart that you're looking at, but it's the annualized change. So yes, the Federal Reserve chopped money supply via increasing interest rates and decreasing their balance. Since then, the money supply is growing again, as you can see, almost back up to median on a growth rate basis. This is really kind of the chart you should be focusing on the most, the rate of growth of the M2 money supply. Because as money grows on a continual basis and increases continually, this pushes the economy forward. The Federal Reserve has done absolutely nothing to get the money supply to all of a sudden stop once it gets to that median level. This is a sharp increase. Not surprisingly, inflation is following suit. This is the core PCE versus the M2 money supply. And I inverted the core PCE because it's from a mathematical standpoint, it gives you what you're looking for. you can see the strong correlation between price pressures and the growth rate of money. Federal Reserve just told us that they're going to be slowing down lowering interest rates. I'm going to continue to say they should have never started lowering interest rates. The money supply itself is growing at this point too rapidly to contain price pressures. This all before Trump. The Federal Reserve, this one's going to bite them. Now, the rate of growth of money versus the rate of growth of the S&P 500. Fairly strong correlation. If the M2 money supply were to continue to grow higher and higher, guess what? So would the S&P 500. The stock market itself is an indicator. It is a lagging indicator. It needs that fuel. Money is the fuel. If there's more and more money in the system, there will be more and more revenue growth for companies and profits. But the Federal Reserve, because of the push in inflation that we're about to see, is going to have to step in and halt the rate of growth of money supply. Now, they are reducing their balance sheet. It is one mechanism, but it's not enough. Here is the Federal Reserve balance sheet itself. They need to drop this faster in order to combat the rate of growth of money supply. Keep one thing in mind. Even though the Federal Reserve sort of communicates with banks via its actions and activities, we're a fractional banking system. All that money growth that we're seeing, you're seeing the Federal Reserve decrease its balance sheet. All that money it printed out of thin air to get this economy moving forward, they're removing that. But the pace isn't fast enough. So we do have the money supply growing rapidly. And why is that? Banks. We're a fractional banking system. These are deposits, commercial bank deposits here in the United States. Fractional banking system. You deposit money into the bank, a bank's going to lend out a fraction of that. That creates money. You've seen the growth in the money supply. You've seen the connection between the growth of the money supply and inflation. Federal Reserve has to do something to halt commercial bank deposits, the growth in fractional banking money. The mechanism for that is you simply ask the question, well, why are people and businesses borrowing and increasing at a rapid rate? Simple. They believe the cost today is worth it versus the benefits tomorrow. Basically, bottom line, interest rates are too low. Comparatively, that individuals and businesses are sitting there saying, we can borrow at this price. Because of price pressures, we can earn more than the cost today. Interest rates are too low. And we're going to see some inflation real fast. Next, we factor in Trump. Two things with Trump: taxes and tariffs. Both of these are actually taxes. Trump's tax cuts, more likely than not, will be extended. Now, they may come in and do something different. He's got a full Congress, so he can pass legislation as he wants, the entire party. No checks, no balances, no like, hey, throw this in. It's all a matter of the greatest tax cut in history. Well, who gets that? We already know corporations are going to get that. How does that affect anybody else? If you're a shareholder, you're going to do pretty well. If you're not a shareholder, you're on your little mouse wheels running. Plain and simple. This is a big transition of money or transfer of money. The tariffs. By raising tariffs as he's doing, he's taxing individuals to pay for the deficit that will be created by his tax cuts for corporations. Plain and simple. Now, I don't care about the politics behind it. Whether you like that or not my argument. I don't care. Here's what will happen economically. this economy will slow down. This is a tax on consumers' incomes via buying things from Canada, Mexico, and China. Everybody's income is finite. So if the government raises taxes off of those income acquisitions or personal expenditures, this reduces the capability of buying things. Because of that, the economy will start to slowly grind slower and slower after prices moved higher and higher. Plain and simple, everything will cost more based on this. Not a lot more, 3, 4, 5%, depending on how it works through the system. But that turns out to be a lot of money. Even if it's 1%, there are ripple effects throughout the entire economy. This is an economy that is very robust. You start taxing that system more and more, this economy will not be as robust. Then we start to look at other things. We go back to the money supply. If there's a big tax on the money supply, this reduces actual money in the system. It takes it out of the system. So in effect, Trump's tariffs and tax cuts are going to save the Federal Reserve. So bizarre. But that's pretty much what's going to happen. Which would mean that the Federal Reserve may be where it needs to be given Trump and his policies. As for the stock market itself, if we see a halt in the growth of the money supply, if we see these taxes moving through the system, this will remove money out of the money supply, and therefore we go back to the charts on the stock market for 2025. If you start taking away the growth rate of the money supply, you start to take away the growth rate of the S&P 500. We will see price pressures immediately. The Federal Reserve is probably not going to be able to lower interest rates at all through 2025. You saw what happened in December when the Federal Reserve said, we're not going to lower as much. If in the next 2-3 months we see price pressures continue to move higher and higher, while at the same time we see employment growth rates that are pretty firm, this means that the economy is moving too fast for the Federal Reserve to lower interest rates. They probably don't want to put too much egg on their faces, so they're pretty much going to say, we will maintain this level until we get to where we need to get to. And from that, the stock market will begin to erode lower and lower. That throughout 2025, the stock market, this bull run is done. Simply, the economy has run its course. Given the parameters we are and what would need to occur by the Federal Reserve, given the current economy and what's going to happen with, of course, the Trump tax cuts and tariffs. Make sure to hit that like and follow button. I also have a link to my Substack newsletter. Thanks so much for the support. We'll see you in the next video. Have a great year.